Welcome to Stock Talk, everyone. Today we're jumping straight into Amazon's first quarter results for 2025. We're working off their official report from May 2nd.
That's right. And the big picture, well, it looks pretty strong for Q1 on the surface. But when you look at their guidance for Q2, there's maybe a bit more caution creeping in. Things like tariffs, trade policies, they mentioned those.
Okay, so a bit of a mixed bag, potentially. Let's dig into those Q1 numbers first. How did the top line look?
Pretty solid, actually.
Yeah.
Net sales came in at $155.7 billion. That's up 9% compared to last year, or 10% if you adjust for foreign exchange.
Wow, okay, so significantly up from the $143.3 billion they did in Q1 last year.
Exactly, about a $1.4 billion hit from currency fluctuations, but still strong growth overall.
And what about profitability? Operating income, net income, did those follow suit?
They did, and then some. Operating income hit $18.4 billion. That's a nice 20% jump year over year.
Right, up from $15.3 billion, and the margin improved, too.
Yep, operating margin climbed to 11.8%. Last year was 10.7% in the same quarter.
Okay, and the bottom line, net income.
Even bigger jump there, $17.13 billion. That's, let me see, a 64% increase from the $10.43 billion in Q1 2024.
64%. What drove that huge increase?
Well, the operating performance was good, obviously.
Yeah.
Diluted earnings per share went from 98 cents to $1.59. But a really important piece, you got to note this, was a $3.3 billion pre-tax gain. It came from their investment in Anthropic Converting.
Ah, the Anthropic investment gain, right. That's a significant chunk and definitely signals their AI ambitions, wouldn't you say? Taking on the big cloud AI players.
Absolutely. It's a clear strategic move. It sets up an interesting dynamic, with vertically integrated AI services potentially becoming a bigger battleground.
Makes sense. Okay, let's shift gears to cash flow. The report mentions strong operating cash flow, but a drop in free cash flow. How did that work?
Yeah, exactly. So operating cash flow, looking at the trailing 12 months, that was up 15%, $113.9 billion. Healthy. But the free cash flow for the same period, that dropped significantly. It's down to $25.9 billion.
It's down from what?
Down from $50.1 billion the year before.
Oof, that's a big decrease. Why the gap?
It really comes down to one thing.
Uh.
Capital expenditures. CapEx. They are spending a lot of money.
How much are we talking?
In Q1 alone, $24.3 billion. That's up 74% from Q1 last year.
74%.
Yeah. And the trailing 12 months, $88 billion spent on CapEx, almost double the $49 billion from the previous 12 months.
Wow. And they expect that to continue.
Seems like it. They're forecasting about $105 billion in CapEx for the full year 2025.
Okay, so that explains the free cash flow, Dick. Where is all that money going? Is it sustainable?
Well, sustainability is the key question, right?
Yeah.
So the report says the main areas are, number one, AWS infrastructure, especially for AI. Number two is developing their own custom silicon, their own chips. And number three is building out their fulfillment and logistics networks. So they're betting heavily on future growth, particularly cloud and AI.
It's a huge bet. We'll need to watch how that investment pays off in the coming quarters, definitely. Okay, let's break down the segment performance, starting with the biggest, North America.
Right, North America. Pulled in $92.9 billion in sales, up 8% year over year. Operating income there was $5.8 billion, which is up 17%. That gives you a 6.3% operating margin.
Solid performance. Any caveats there?
Yeah, they did mention some one-off charges, things like historical customer returns and, interestingly, pulling inventory forward because they're anticipating potential tariffs. Without those charges, they said the margin would have been more like 7.2%.
Got it. And the international segment, how did that fare?
International saw $33.5 billion in sales. That's up 5% as reported, but 8% if you strip out the currency effects.
And profitability. It used to be a drag, didn't it?
Much better now. Operating income was $1.0 billion, a really significant improvement from last year. Margin came in at 3.0%, and same story as North America. Some one-time charges hit this segment too. Without them, the margin would have been closer to 3.7%.
Okay, good improvement there. Now, the star performer usually, AWS. How did Amazon Web Services do?
AWS revenue hit $29.3 billion. That's a strong 17% year-over-year growth.
17% is good, but I feel like I heard that was maybe a slight miss versus expectations.
You heard right. It was the third quarter in a row where the revenue growth, while strong, came in just a tiny bit under what analysts were forecasting. They expected maybe 17.4%. Management kind of brushed it off, saying AWS growth can be lumpy, big enterprise deals, the timing, plus the huge demand for AI.
Right, but the profitability, that looked really strong.
Oh, absolutely. Operating income for AWS jumped 23% to $11.5 billion. And get this, the operating margin was 39.5%. That's incredibly high. Their best since at least 2014, maybe ever.
Wow, nearly 40% margin. So even with a slight revenue miss, the profit engine is firing on all cylinders.
Exactly. Operating income actually beat expectations, even if revenue was a hair light. And they hit a $117 billion annualized revenue run rate.
$117 billion run rate. That just shows the sheer scale of AWS now.
It's massive. Just to clarify for listeners, that run rate is basically taking the Q1 revenue and multiplying by 4. It gives you a sense of the current annual scale if things continued like this.
Good explanation. Okay, let's talk growth drivers, especially AI. We mentioned the Anthropic gain, but what else is happening with AWS and AI?
Well, AWS is clearly the profit engine, and AI is central to its future. But here's a key point from the report. They're actually facing some capacity constraints.
Constraints, meaning they have more demand than they can handle right now.
Essentially, yeah. Demand for AI services like training big models or just the computing power needed is apparently outpacing their current infrastructure.
So that massive CapEx spend makes even more sense now. They're racing to build out capacity.
Precisely. It explains why they're spending so much. It might even be limiting how much AI revenue they can book in the short term, despite the huge demand out there.
Are they just throwing hardware at it, or are there other angles?
Other angles, too. That custom silicon piece is important chips like Trainium. Developing their own AI chips could make them less reliant on, say, NVIDIA, and maybe cheaper in the long run.
And there was an accounting change mentioned too, wasn't there? Something about server lifespan.
Yes, good catch. They shortened the estimated useful life for their servers from 6 years down to 5 years.
Why do that?
They said it reflects how fast AI technology is advancing. Basically, the hardware gets outdated quicker now. It means they take the depreciation hit faster. It increased depreciation by $217 million in Q1, and they expect it to impact the full year by about $700 million. It's a sign of just how fast things are moving in AI hardware.
Interesting. Okay, shifting from the cloud back to the ground, e-commerce and retail. How did that side hold up amidst all the AI focus?
Retail kept chugging along. If you combine North America and international retail sales, they grew 7% year over year. That's $126.4 billion.
And they always talk about delivery speeds.
They did again. Record Prime speeds, apparently. Over 2 billion items delivered same day or next day globally in the quarter. And in their top 60 U.S. metro areas, almost 60% of items arrived that quickly.
That's impressive logistics. What about third-party sellers and advertising?
The share of units sold by third-party sellers held steady at 61%, so still a huge part of the marketplace. And advertising continues to be a really bright spot. Ad revenue grew 19% to $13.9 billion.
19% growth in advertising is huge. Is that becoming a bigger profit driver relative to actual retail sales?
It certainly seems that way. The margins on advertising are generally thought to be very high, so that kind of growth definitely helps the bottom line significantly. It's a really important part of the Amazon story now.
And on the retail side, you mentioned they were thinking about tariffs.
Yeah, they specifically called out focusing on low prices, but also encouraging sellers to get inventory into the U.S. before potential tariffs hit. So they're clearly planning for some potential disruption there.
Okay, that brings us to the forward guidance for Q2. You said earlier it seemed a bit cautious, and that's what might have worried investors.
I think so, yeah. The sales guidance for Q2 is between $159 billion and $164 billion. That's still decent growth, 7% to 11% year over year.
But the operating income guidance was the issue?
That seemed to be it. They guided for operating income between $13 billion and $17.5 billion. Now, Q2 last year was $14.7 billion, so the range includes potentially lower or slightly higher year-over-year results. But the midpoint and even the high end was below what analysts were expecting, which was closer to $17.8 billion.
Ah, okay. So that miss versus expectations likely caused the stock to dip after the report came out.
Probably a big factor, yes.
Did they give specific reasons for that more cautious operating income outlook?
They did. They explicitly flagged, quote, tariffs and trade policies, end quote, and also recessionary fears. So macroeconomic uncertainty is definitely on their minds.
Makes sense. Any other factors?
They also mentioned the usual seasonal stuff, like higher stock-based compensation costs in Q2 and ongoing spending for Project Kuiper. their satellite internet project.
Right, Kuiper. So a mix of macro worries and internal spending impacting the near-term profit outlook. It really shows how even giants like Amazon aren't immune to these wider economic pressures.
It really does. Makes you
Mhm.
think about how nimble these huge companies can actually be when faced with that kind of external uncertainty.
Okay, wrapping up then. What did the report highlight as the key opportunities and, conversely, the biggest risks going forward?
Opportunities-wise, it's pretty much what we've been discussing. Continued growth in AWS, especially leveraging AI. Also, the high-margin advertising business, getting more efficient with fulfillment, growing the third-party marketplace, and eventually benefiting from those custom silicon investments.
Standard playbook, but with a heavy AI emphasis.
Yeah.
And the risks.
Risks included that big cloud of uncertainty around tariffs and global trade. Definitely number one. Also, rising competition in cloud from, Microsoft and Google.
Always a factor.
Right. Yep. Then there's the pressure on free cash flow because of all that heavy CapEx spending we talked about. Plus, those AWS AI capacity constraints potentially limiting near-term growth, even with high demand. And finally, just the broader risk of economic slowdown hitting consumer and enterprise spending.
So summing it all up, it sounds like Q1 was strong, good growth, impressive AWS profits,
Definitely.
but overshadowed maybe by this massive investment cycle impacting cash flow right now and a cautious Q2 outlook thanks to those external economic and trade worries.
That captures it pretty well. You've got strong current performance, but it's coupled with this huge spending for the future, particularly in AI, which hits the cash flow now. And at the same time, they're trying to navigate these potential headwinds from trade and the economy, which adds a layer of uncertainty to the next few quarters.
It really sets up this tension, doesn't it? How does this enormous investment in AI infrastructure, even with the current bottlenecks, position them against competitors long term?
That's the multi-billion-dollar question, isn't it?
And you have to wonder how much those external factors, trade wars, economic slowdowns, could potentially throw a wrench in those ambitious plans or maybe even accelerate certain aspects. This whole balancing act, managing today's success while making these huge bets on the future. What does that signal for the rest of the tech industry and maybe even for us as consumers down the road? Something to think about.